The Reserve Bank is warning about household debt this afternoon, saying any rise in unemployment could set off a disastrous chain of events. Thanks to the rising cost of living, hundreds of thousands of families are left with little to no disposable income once all the bills are paid. And if you couple this with reports from last week that up to 1 million households could be in danger of missing their mortgage repayments, well, we are in a difficult position. Martin North, the property market analyst from Digital Financial Analytics, joins me on the line. G'day, Martin.
Hello, Ben.
People are very close to the edge here.
Yes, a large number, unfortunately. About 1 million really don't have much ability to cope with any rises in interest rates at the moment, and that's about a third of those households with owner-occupied mortgages, so it's quite widespread. And it's been building for a long time because we've got households with very large mortgages thanks to very free lending from the banks and high home prices, cost of living rising, and income's absolutely going nowhere.
When we talk about household debt, obviously mortgage repayments are the big one, credit card bills. What else are we considering when we talk about household debt?
Well, it's quite diverse. It's interesting that auto finance, in other words, car loans, has been growing quite fast, and quite a lot of people have a lot of exposure there, and store credit as well. But the concern is that a lot of the consumer debt is actually grabbed by people with very high mortgages as well. So, in fact, once you get into difficulty, what you tend to do is to then reach for another loan, and even a payday loan, to try and get through. So, effectively, you build debt on debt on debt. So, the problem we've got is that we've got households with a lot of debt, and then more debt added on top, and then no way out.
The real threat is this large number of people falling behind on their mortgage payments over coming months. Up to 1 million households could be in danger by September this year.
Yeah, so that million is in stress. Not everyone's going to, default tomorrow, so it's not going to go from 0 to 1 million. But it's an indication of just how sensitive many households are. And look, there's very little opportunity probably for more income growth in the next little while, and yet we know that costs are rising, electricity costs, all those things. So it's really ultra-sensitive. And now interest rates are looking as though they could rise even a little, and that really starts to then create massive headaches for many people.
Let's talk about that for a moment before I let you go, because when you slip that into the conversation and say, oh, they might just raise a little, well, there are a lot of people who are banking on them going nowhere, because if they do go up, they're in a lot of strife.
Yeah, and we're not talking here the RBA moving. I don't think they'll do anything for a long time. But it's international funding pressures. So effectively the strategy in the US, what Trump's been doing is lift in terms of tax reform, and also the Fed there lifting rates. That's translating through into higher funding costs for the banks here. And also, people are actually voting with their feet by taking deposit from the banks, and indeed big corporates from the US are repopulating money back to the US. So the banks need more overseas funding to be able to support, and that's a higher cost. So effectively there's this pressure on the banks to lift rates. Only a small amount maybe at the moment, but enough to make a big difference. Always
good to get your expertise, Martin. Thanks for your time.
Good to talk to you.
The property market analyst from Digital Financial Analytics, Martin North, after the Reserve Bank is warning about household debt. And any rise in unemployment could set off a disastrous chain reaction. 131873, the open line number, ben@2gb.com if you'd like to send an email